Hello everyone, I am Suraj Deo and welcome back to Deo Talk. Today's video is about something which 90% of Indians never do, but everyone must do. That is a yearly financial review. Most people keep searching for best stock, best mutual funds or best tax savers, but they never check whether their personal finance foundation is even strong or weak. And yes, many of us feel like our salary just disappears every month. Not because we don't earn enough, but because our money decisions simply don't match our lifestyles and goals. That's why this annual review is so important. See, one more year has already ended. And before you jump into tax saving investments, treat this exercise as your monthly health checkup. If you skip this review, chances are you will repeat the same money mistakes next year also. So today I will share a simple 7-step framework that will help you understand why your savings are low, why your debts never end, why you feel stressed about money, and what exactly you need to fix this year. This one review done once a year can genuinely change your financial life. Alright, let's start. Step 1. Start with the money reality check. Ask yourself this one powerful question. How much money you received and how much you spent this year. This is your financial x-ray. Your income sources can be salary, business income, freelancing, rent, interest, dividend, bonuses, anything. And expense categories like rent, EMIs, groceries, fuel, medical, subscriptions, eating out, online shopping, travels, kids expenses, etc. You don't have to download 12 months of bank statement or credit card statements. Today, most banking or credit card apps auto-categorize your expenses. Just use that. Also, you don't need to track every rupees 10 or rupees 20 GPay transactions for chai, coffee, samosa, etc. Just understand your big expense patterns. This is where 90% people get their first shock. They realize they spent way more than they thought on Swiggy, Zomato, Flipkart, Amazon, EMIs and UPI splurges than they imagined. Step 2. Identify the silent money killers. Some people don't become broke from big purchases, but from small repeated mistakes. That's why it's so important to track where your money has actually gone throughout the year. When you see your spending patterns in detail, you quickly spot lifestyle inflation. That is the mindset of income बढ़ गया तो expenses भी बढ़ जाना चाहिए. So please review your auto pay subscriptions, EMIs, online shopping impulses, food delivery addiction, weekend lifestyle inflation, credit card minimum payments, or buy now, pay later loans, etc. These silent killers eat your money and you don't even realize it. Here's one rule you can use. If you regret an expense, just remove it next year. This single step can improve your savings rate more than any mutual fund in the short run. Step 3. Calculate your net worth. That is your money scorecard. Net worth simply means assets minus liabilities. It doesn't matter whether you earn 5 lakhs a year or rupees 50 lakhs. Your net worth tells you your real financial position. Because your income shows how much you earned, but your net worth shows how much you have actually built. Knowing your net worth gives you a clear starting point to understand where you are financially and what needs to improve next. So list all your assets. Bank balance, FD, mutual funds, stocks, gold, PPF, PF, NPS, property value, crypto, everything. Then list all your liabilities like home loan, car loan, personal loan, credit card, BNPL dues, etc. The difference of these two will give you your net worth. Tracking this once a year answers some powerful questions like, are you actually building wealth? Is your debt reducing? Is your investment growing? And is your financial life improving or not? So if you want financial confidence, then track net worth annually. One quick request. If you are learning something new from this video, please hit like and subscribe. It helps the channel reach more people. Step 4. Debt detox. That is clean up your loans. India is slowly turning into debt heavy society. People getting into EMIs for everything. EMIs for phones, furniture, vacations, even groceries. But no investment can beat the damage caused by bad debt. See, debt management is a core part of personal finance. You can be investing in the best mutual funds, but if you have high interest loans, your financial progress gets destroyed. Yes, a long outstanding credit card loan charging 36 to 48% interest will destroy even the best SIP returns. So here's how you can and you should clean up your loans effectively. Method 1 is avalanche. Close the highest interest loans first and then move to the next. You can follow this order. First credit card, then personal loan, then BNPL, then car loan, then finally home loan. Method 2. Snowball. Here close the smallest loan first. It gives you quick wins and keeps you motivated. See, whichever method you choose, but please stop taking new loans unless they are absolutely necessary. And yes, even one extra EMI paid every year in home loan can save you lakhs in interest. Step 5. Insurance review. That is your financial seatbelt. Today somehow personal finance is turned into stock tips, quick money tricks, etc. But that's not where real financial planning actually begins. Before you even think about investing, your first priority should be defense or protection. that is the right insurance and a solid emergency fund. That's the foundation that protects everything you build. You know why this is so important? Suppose you have created a great investment portfolio but have no big savings and no insurance. The moment a medical emergency hits, you will be forced to sell your investments, regardless of whether it's in profit or in loss. This is the harsh truth in India. Many families are just one serious medical incident away from complete financial collapse. In fact, most people buy insurance only to save tax. But the real purpose of insurance is to protect your wealth, not reduce your taxes. So start with these two types of insurance first. Number one, health insurance. You know, medical inflation in India is rising at 10 to 12% every year. One hospitalization without insurance can wipe out your years of savings. So you must buy a health insurance first and also keep reviewing your cover every year. Number two, term insurance. If anyone depends on your income, like your parents, spouse, kids, etc., then you must buy a term life insurance. Not ULIP, not endowment plan, not money back policy, sirf pure term insurance. And do review your term insurance coverage once every year for any life changes like marriage, kids, etc. See, insurance is your defensive shield. You should start investing only after that defense is strong. Step 6. Emergency fund. That is your survival cushion. Health issues aren't the only surprises life brings. It could also be a sudden job loss, an unexpected home repair, or even an urgent house shift if you are renting. And in moments like these, you should not be forced to sell your investment at a loss or take on personal loan. That's where your emergency funds comes in. The formula is simple. Keep 6 to 9 months of your essential expenses aside. Park it in a liquid fund or a savings account, not in the stock market. If your job is unstable or income unpredictable, or you have dependents, then keep a larger buffer closer to 12 months. Step 7. Credit score and report review. The last step in your yearly financial review is to check something most people ignore. That is your credit score and credit report. Once a year, download your credit report from all the 4 major bureaus like CIBIL, Experian, CRIF and Equifax. You know why all 4? Because sometimes one report has an error which others don't. So check for wrong loan entries, incorrect personal information, EMI status errors like showing late even if you have paid on time, or any loan or card you have never opened. These one simple correction in your credit card can improve your credit score and help you get cheaper loans in the future. Now, as a final step, measure your money progress. At last, ask yourself, did my savings improve this year? Did my debt reduce? Did my net worth grow? Did I invest consistently? And did I protect my family financially? See, financial progress is like going to the gym. You will not see results daily, but you will see results yearly for sure. So do this review every year and your financial life will start improving automatically. That's all for today. Let me know in the comments which of these 7 steps was new for you. Thanks for watching and take care of your finances and smile. Always smile.